Okay, hey everybody. Dan here. Weekend study session first. Um, Happy Memorial Day to everybody. Nice 3-day weekend. Just remember what it's for. Thank somebody for their service would always be nice. We'll get into it here now. I mentioned this earlier, and I got a lot of really encouraging comments about the new direction here. We'll just talk about the weekend study session, but just in general, what's going on for us, for you, in Stock Market Mentor, and that is that we're going to be, of course, we're going to be doing a lot of stocks. I mean, the bottom line is we got to make you. You got to have stock picks to make money. That's kind of a given. But what I really want to do is take this to the next level where I don't see anybody else really doing. And that is giving you an entire structure. I know a lot of trading resources, at least the ones that I've seen, been exposed to. A lot of trading resources. They'll give you stock picks, and they can be great stock picks. But the question is, what are you going to do with those? And no matter who you are, there's a bunch of you watching this, and each of you is individual to the next. Each person has their own specific trading. Maybe you've got the same strategy, but you definitely have a different style, and that style would be uh, that I might as well just talk to you here for a second. Okay, weekend attire. Anyway, the style would be different to you versus anybody else. And the reason is because we all have the same or different emotional makeups. We also, I mean, some people are really risk averse, which is, I think it's important to be focusing on risk one way or another. So some people are really risk averse, while others are, you're kind of trading. You should never be trading your net worth. Never. You shouldn't be trading your lifestyle. That is just a rule, because I will tell you this. If you ever find yourself trading your lifestyle, sooner or later, you're going to have to adjust your lifestyle, and it ain't going to be upward. And the reason is because if you have a big vested interest, financial interest in something, then you have a big vested emotional interest in that too, which is why just plain paper trading without focusing on rules, without any kind of discipline. If all you're doing is paper trading, you don't have any emotional investment in that. So you can sit there and watch one stock go against you and go, well, it's only a paper trade. We'll see how it works out. And then it continues to fall and fall and fall. Okay, fine. But then you don't care because you just hung on to it anyway. And then it comes back up and it ultimately makes a profit for you on paper. Of course, you don't get the money, but you also didn't experience the pain of seeing that position fall so far that you're wondering if you should average down or shoot yourself. And that is a key part of trader development. You have to get past that aspect of not having any kind of an emotional attachment with a trade. And you can do that, by the way, by paper trading. That's one of the things I recommend people do with Trade Track. If you're not really I don't know, I can't think of a better word. If you're not really good at trading yet, or if you're not really accomplished, you're brand new. And by the way, you may have been trading for 20 years, but now you're brand new because you're seeing things a little bit differently. But anyway, the bottom line is, if you're still kind of struggling, then the best way to get through that is to paper trade, because if you don't have enough money to put on the line, you paper trade. But you have to paper trade with rules. You must have non-discretionary stops. You take a trade, you know where you're taking it, you put your stop here, that defines your risk. If you are stopped out, you're out. That's it. Because you're not trying to make money. You're not looking to see if you really got Well, I was going to say balls, but I can't do that. If you really got the courage or whatever you want to call it, stubbornness to ride through a serious drawdown only to see it go back up, like those things are bad habits. But if you are just trading or you're trading really, really small to where a win doesn't get you excited, a loss doesn't get you bummed out, you're just kind of trading without a care in the world with no rules. Okay, that's not good. But if you're trading with rules, now you're okay. If you're trading with rules, again, it can still be I'm trading without a care in the world. Okay, well, why is that? You got money on the line. Well, yeah, I also have a process. I also have a method, a strategy. I have a way to trade that over time has been pretty successful for me over time. As long as I stick to the process, I ain't going to make money on every trade. I may not make money on half of my trades. Sometimes I'll make money on 60 or 70% of the trades. Thank you, Mr. Market. Other times I may struggle to get 3 out of 10. But either way, I'm sticking to my process. And as long as I'm sticking to my process, then I'm trading without a care in the world because I'm going to take losses on some, and that's okay because they're small. I'm going to take profits on others. Some of those might be small too, but some of them might be really, really good, really, really big. All the while, I'm sticking to my process. That's what I am. I'm not a stock trader. I'm not an option trader. I'm a process trader. And when you are a process trader with all the rules, now you literally are trading without a care in the world. Well, maybe a little care, but you get my point. If you're trading to where every trade is according to a process, then here's the thing. You don't have any failures. None of your trades are going to fail. You really don't even have losing trades. What you have are outcomes, and there's a difference. That's part of NLP, neuro-linguistic programming. That's one of the things that you learn is that there's no such thing as failure. There's only outcome. And you can go ahead and describe things as, well, my business failed or that failed or this failed. And I don't know how else you'd describe it, but in your mind, you don't want to look at it as a failure. You want to just say, okay, well, this is the outcome. I mean, this is one of the reasons why entrepreneurs are so good at failing because they try a lot of stuff. Some of it works. Frankly, most of it doesn't. If you're an idea guy, most of your ideas aren't going to pan out for various reasons. But is that a failure? No, man. I'm just thought it was an idea, and at least I failed quickly, as opposed to agonizingly over millions of dollars or something like that. So the point is, you want to be always focused on process, always focused on not just risk. I talk about risk all the time. Start with risk, but I'm modifying that a little bit. And I'm saying start with reward first and then wonder, is it worth the risk? So it's still risk reward. But the point is, if you're doing all of these things, you're not going to fail. You'll just have different outcomes on various endeavors, various trades. And I'll show you some stuff right at the end of this thing about our 59-minute trader sessions. They were really good, both of them. Totally different, but people made a lot of money in both of them. But the point is that one person said, hey, and he made a really good amount of money, but he was really encouraging. And he said, hey, guys, if anybody's really struggling here, don't worry about it. I mean, if you stick to the process, you're going to get better. He was really encouraging. And this goes beyond day trading or 59-minute trader trading, as I call it, because after that, you're just busy giving your money back. But he was saying, look, if you just stick to the process, know that you'll get better at it. You'll get better and better. And as you get better and better, you're going to make more money. So it doesn't matter. It shouldn't matter where you are right now. If you're just, I mean, look, let's be real. If you're just starting trading, you're not good enough to make a bunch of money. You're not. I've told this story many times, so some of you might be bored with this, but it's about Huey Lewis. I heard him interviewed on some radio station. It had to be probably almost 25, probably about 25 years ago, about him being in a pro-am golf tournament. So he was obviously the amateur, and he was really playing pretty bad. And one time he shanked one into the. I don't think he got lost in the woods. I think he got buried in water, but he shanked a really, really bad shot. And so he tossed his club, and the pro that he was playing with said, "What's wrong? What's going on?" He goes, "Oh, I'm just playing really bad. I really suck today." And the guy looked at him and he looked at him like puzzled. And he said, "You're not good enough to get mad." And that really, really struck me because it's almost like a rule of life or of any endeavors that you venture out with. You know, anything that you're trying to do, anything they say, anything that's worth doing is worth doing well. Okay, so anything that's going to be profitable isn't going to be done overnight. And so I want you to really be focusing on the things that I'm talking to you about, not just today, but over these weekend study sessions. I don't know, for as long as I'm alive, and I'm pretty damn healthy. So I want you to be focusing on this and realize that all the things that I'm teaching you, all the things that I'm showing you every week, they're intended to help you get over the hump, to help you get to where you want to be that trader that you know you can be. I mean, frankly, you flip and think you should be now, but you aren't. And that can be really frustrating. I've coached traders in various venues, and some of them, I'm thinking about one in particular who was really impatient with himself, and he was really struggling. And so I said, I worked with him a lot, and he was really struggling. Sometimes he'd take a big loss, but not very often. Most of the time, he would be in the right stock, and we'll go into this a little bit today. He would be in the right stock, but he would sell it for like a 5% profit, only to see it go on for another 20%, 30%, whatever it is. In other words, he would sell too soon. And then I was looking at his losses, and his losses were actually really tight too. So I want you to think about this and ponder, does this pertain to me? What this trader was doing was he was very concerned about risk. He was very concerned about losing money, and that's a good thing. That's a good thing. He was very concerned. He was playing all his cards really close to the vest, really close to the vest, not putting much if you're gambling, not putting much money in the pot, that kind of thing. And so he was really keeping his losses tight. But the problem for him was he wasn't allowing the stocks that he was right on to pay him off. He was just saying, okay, well, okay, I'm going to sell this stock. Oh, I took losses on the last two stocks, so I got this one. I'm going to sell it and it's a 5% gain or something like that. And so the idea to me is, and I've been at this game for more than 30 years and really struggled myself to get over my hump because I can be emotional sometimes. I always have been. And if that bleeds over into your trading, man, you got a real problem. And so this is one of the reasons why I just decided like, hey, man, I got to be a rules-based trader. I got to be a rules-based trader or I'm going to blow up again. And so that's why I'm doing what I'm doing now. But the idea is if I'm describing you where you're taking pretty small losses, but you're also not making many gains on the stocks that you're trading, I think what's happening is you're not able to get over the emotional hurdles. You're not able to, I almost want to say, do robotic training or trading. You're not able to really look at this and say, okay, I've got a stock that's making money now. This is totally independent of the last trade I took or the last 19 losses in a row that I've had. Whatever it is, today's a new day. You can't go back to yesterday. You can't go to tomorrow. Live in the moment, make the trade. But you make the trade with your rules. You really, really got to do that. I can't emphasize that enough. You have to be a rules-based trader. Now, are there exceptions to the rules? There shouldn't be, but there are. I just say it, there are. Sometimes you say, well, and I'll be talking more about this in the in the weeks and even months to come on the weekends. But sometimes you look at a trade and you have a lot of experience. You've seen things and you've seen big moves in stocks that have not met your rules, have not met your strategies yet. They've still been big winners. And you look at it and you have two thoughts. First of all, crap, I should have bought that stock. Second of all, well, it didn't fit within my rules. And so this one worked out, but my rules tell me, my experience tells me that a lot of them don't. And so I made the right decision in not taking that trade, even though I saw the trade move up, right? Okay, so after a while, here's the thing. Like you look at enough of those types of trades that didn't work, or that you look at enough of those types of trades that didn't suit your process, but you just look at them and watch them go higher. And you knew they would go higher, but they didn't fit your process. Maybe you have to say, okay, well, that's a different part of my process. I'm now, I know two styles of dancing. I can do ballroom dancing and I can do salsa. Now I can do neither. Jennifer tells me, don't try to dance because it's really ugly and I'm no longer attracted to you. But some people, you're dancing fools, right? So, and that's, ABBA sang about that. So the bottom line though is if you see a certain pattern that seems to always work, but it doesn't fit your process, okay, well then develop a new process. Now you've got two. One thing that comes to mind, I'm not going to show you. I haven't prepared for this. I'm just kind of speaking off the top of my head here. One thing that comes to mind are these power moves where a stock breaks out, runs up 50%, at least 50%, and then it doesn't just reverse like it's a blow off top, but it runs 50% and then it holds in the pattern for a certain amount of time. And this is a classic Bill O'Neill trade. Mark Minervini also teaches. It's why I'm teaching it too, not here, but it's a power move where the stock moves enough and then it doesn't come back down. It trades on low volume. So what is that telling you? It's telling you, wow, there aren't a lot of sellers, even at this 50, 60, 70% gain. Not a lot of sellers, but what there are buyers that are taking that stock and holding it, keeping this stock up. They want it even at that higher price. And so at that point, you don't buy the stock, but you wait. You wait to react to the next breakout. Doesn't mean that it's always going to come. But if it does come, what I've just described to you is a viable trading pattern. It is. That's a viable trading pattern. So if you do a little more work on that, and maybe if you want me to look at some or find some, just post it in the forum or email Karen at stockmarketmentor.com. And I'll see if I can get into that in a little more detail. But what I just described isn't really a key, it's not a part of the process that I teach, but I'm showing you now. Like I know a lot of different ways to trade, and I will be, I really work on teaching you as much as I can, but it has to be within the framework of a strategy, of a trading process. Okay. So anyway, thanks for bearing with me on that. Not that you had a choice because this is a video as opposed to a live session and you can't leave. But this is what it gets down to. If you really look at this, I got to share my screen here. Okay. Okay, if you really look at this S.M.A.R.T strategy, market, actionable, risk, reward, and track your trades, if you really look at this strategy, I think it's an excellent strategy. I was just really lucky that I found an acronym that was SMART instead of something else. But if you really look at the different components of this, this can apply. It definitely applies to business. No question about it. Since I started applying my own strategy to business and not just stocks, I'm changing a lot of things because some of the things that I've been doing just don't meet the strategy that I have, or they don't meet not the quote market conditions, but just what am I trying to get into? And I could go on, but I won't. Let's just stick to trading. If you don't have a strategy, then you're really going to struggle. And I have slides on each one of this, so I'll get to it. But you have to be looking at market conditions. Does your strategy fit into the market conditions? Okay, this is good. Now, is it actionable? Because part of a strategy, you got to have some kind of action. There has to be, otherwise, just, well, there's a stock, I'll buy it. And then you also have to look at the reward versus the risk. And then finally, you have to be monitoring or tracking your trades. And I've given you guys a real simple way to do this, like almost like you can't excuse yourself and say no, it's too much trouble. And I'll get to that when we get to that section. But I'm just going to kind of walk you through some basics here, and then I want to show you some things on a base breakout strategy. So strategy first, then the stock. You want to be looking at like what kind of trade, what type of trade am I doing? Am I a swing trader? Is it just like a position trade, like I want to build a position, longer term position, or is it a momentum breakout? Are you doing any of these? Are you doing all of these? Is this a pullback entry? Do I have an income strategy where I only focus on high yielding stocks? Or I do like the wheel strategy where I own a stock and then I sell calls against it or puts. And by the way, I'm actually writing a book in the crypto space called the Crypto Income Engine, because most of you probably don't know this, but you can actually write covered calls on crypto. Not every coin, but you can write or sell call options, just like you do a stock, sell call options against your crypto. Okay. Well, that's an income strategy. I won't get into that now, but that's an income strategy. So what I'm saying is if you don't know your strategy, then you don't know what to do next. And also you're not going to get better at it because there's nothing to get better at. Only takes a minute to click your mouse. Then you're back on the sidelines, either waiting or watching. Okay, so you got to have the strategy right. And then market conditions. Is the overall market healthy? Is institutional money flowing into stocks? And also the sector. I don't, for whatever reason, I just haven't talked too much about this in our live training sessions, but I think I'll probably start focusing on this a little bit more. For example, the like the Nasdaq or the S&P can be kind of sluggish, but then if you're looking at the semiconductors, the SMH is cranking it. So you have to get past the market and just look at the sectors and say, well, the market may be weak, but this sector is doing well, or this industry group is doing well, and my stock is in that sector. It's in that industry group. And so what you're doing is you're looking at the market in a more concentrated or granular level. So that's really important. And also, like, our growth stocks working? Sometime lately, the answer is yes. I mean, it's almost hard to remember when growth stocks weren't working. There does come a time in bear markets where value stocks start to work better. But in that case, the overall market is typically not healthy. So that tells you something too. But then also, it really, really gets down to this. Is the stock trading with or against the market? We want to see, we want to always be swimming with the current, not against it. And you will find that you can be, and this can be a cause of problems for a lot of traders, a lot of new traders. You've got a particular strategy and it works really, really well. And it has been working really well for a while the market's been really strong. But you're just looking at your strategy and you're saying, yeah, I got a good strategy. And then the market turns, but it's not really noticeable to you because your strategy is still working. And then after a while, it kind of doesn't work so well. And finally, you're scratching your head wondering what's going on. And what's going on is you've got the good stocks, you've got the proper breakouts, you've got everything on your side. But then Mr. Market says, well, we'll see about that. And you get crushed with a lot of selling because it's like, it's remember, you know that hopefully none of you have been on the receiving end of this, but when the girl breaks up with you or you break up with the girl and you want to let them down easy and you go, hey man, it's not you, it's me. Okay, that's what the market can be telling you. I know you're in the right stocks, but it's me. And so always be mindful that the market conditions absolutely matter. Okay. And then we're looking at actionable. And I mentioned this when we were talking about strategy. If you just have a strategy, but you don't have a specific trigger, a specific thing that has to happen before you actually put your money to work, then you don't have the complete trade. So you got to have the strategy. The market needs to be setting up for you. And then you have to have that one trigger that says, yes, I'm in. Is the stock ready to go? And again, I've got a breakout slide that I'll show you that walks you through this. But it really gets down to, am I early or am I chasing? And if you're somewhere in the middle, you probably got a good trade going. But ultimately, it's just like NTNT, no trigger, no trade. And then risk versus reward is for the R. I say every good trader, every very, very successful trader always focuses on risk. They start with risk first. All right. You can read it everywhere. I want to modify that because I know this is true. And I've said this, I haven't said this in quite a while, but I'll say it now. You can buy any stock at any time and have virtually zero risk. Prove me wrong. Buy any stock at any time and have like a 2% risk. You know how you do that? Set your stop at 2% below where you buy the stock. That's it. You can buy a total blow off top, bubble, the whole bit. Buy it right at the top. Set a 2% stop. You've done that and you have like virtually zero risk. But what was your potential reward on that? Not very good. And if you're buying, like in that case, if you happen to be buying, say, right in the middle of this big move higher, then sure, that would have been great. Some trades work out awesome, some trades don't. But you have to look at it and say, well, I kind of lucked out on that one. But over time, what you need to be doing is you have to be focusing first on is, as they say, is the juice worth the squeeze? But is the potential reward even worthy of me putting my money into this stock? Because I can buy a stock and say, well, I'll just keep a stop at 4%. Okay, well, that's fine. So far, you're just planning on losing 4%. It's like walking through the casino, through the blackjack tables and having 500 bucks and saying like, okay, well, you know, if I lose 500, or I should say when I lose 500 bucks, I'm out. Okay, well, you just set a stop loss on your losses. And if you stick around long enough, you're going to wind up losing money. So trading without considering the reward, considering the upside before you make the trade, that frankly is you're planning to lose and you're deciding how much you're going to lose because most charts don't give you anything. And when I'm in my weekly live training sessions, most of the stocks that I get asked about, and this is all good, like bring a stock, ask me about it. Most of the stocks I get asked about, though, I look at it and I think every once in a while I'll say, I need to put this on the active trade list right now. But most of the time it's like, no, that pattern's just all sloppy, or no, that doesn't work because of this or that. There's like always something, and a lot of times many things that are wrong with the stock that make it not part of my trading strategy. And so what you have to realize is what I'm looking at there is I don't see enough potential reward, and not like wishful thinking, oh, this time is different. I don't see enough potential reward to merit me taking any risk, because one thing you don't hear about, few people talk about it, is the risk of time. And that kind of gets back to the entry, but I've talked about that. I think it was just last week. But is the risk of time. If you're in a trade and you haven't gotten a trigger that tells you it's go time, so you're just in the trade, what you risk is your time. Are you just kind of wasting your time? Is your money sitting in a non-returning asset? It's just that's a problem that most people don't realize, because if you're sitting in something that's really not making you any money, then over time it gets kind of frustrating. You start to get bored. And then after a while, you can get resentful. You can start looking at yourself like, what the heck am I doing? Now I'm afraid to sell it because I know as soon as I sell it, now it's going to blast off. And the next thing you know, just emotionally, you're just feeling bad. You're feeling inferior, and you're feeling like maybe I'm not cut out for this stuff. But what's really going on is you're not considering the time aspect of risk. And it's a big deal. Just stop and think about it. It's a big deal. If you happen to get a stock, you get it just right, and it was for a long-term trade, and you're assuming it's going to do whatever it's going to do, and then within a week or two the thing pops up 30 or 40%. Okay, well, don't look at that and say, well, it's a long-term trade, so I'll just hang on. No, you can hang on to some of it. That's fine. But did you really expect your long-term trade to be up 40% in a week or 2 weeks? No, you didn't. If you did, you'd have loaded the boat and been all in. But instead, it's a long-term position, but it really, really outperformed in a short matter of time. And so you say, well, I got to take some profits on this thing. Maybe I won't sell it all. Maybe I will sell it all and then wait for it to pull back, use the profits that I just took, buy some more stock, and my cost basis is even lower. The point is, you have to be looking at the time value of risk and the time value of reward. So it's just really important that you be mindful of this type thing. But think about it. This is S.M.A.R.T, 5 letters. Like, it would be tough if it was like honorificabilitudinitatis. Like, that would be a process with an acronym that's really not even an algorithm could figure that out. So we're going to keep it SMART, right? And then finally, again, tracking your trades, because this helps you understand. Well, I'll put it this way. If you're not measuring things, if you don't exactly know what mistakes you're making, you're not going to be able to fix them, because you don't even know what to fix. You just know that you're confused when some of your trades work out and some of them don't. And so only when you look at what your trades are actually doing can you really see what you are doing. And the easiest way, again, I talk about Trade Track, and I will sometime next month. I'm going to be, let's just say, making it a little more accessible to you, actually a lot more accessible to you, because what I want to do is I want to take away your excuse for not tracking your trades. As an aside here, Mark Minervini had a, I don't know, he was webinar a few weeks ago, something like that. And one guy had a question about his trades, and he was frustrated. He's kind of the trader that I just mentioned, where not that guy, but where he was taking small losses, but he was also taking small profits, and he wasn't really making any money. And what's he doing wrong, and all that kind of stuff. It was kind of a detailed question, and Mark said he was very matter of fact. Sometimes Mark can be really matter of fact, but in this case, he was just answering him, and he said, nowhere in your question do I see any indication that you've actually tracked your trades, that you've actually measured your trades, you've actually looked at them. Instead, you're just looking at the results. But I can't help you if you do not know what you're doing. And here's the thing, it doesn't have to be a big numerical exercise. You don't have to get in a parade of calculators. All you have to do on a very, very minimal, basic level is go back to your, I mean, it doesn't really help to do it in real time. Well, it does like it would with Trade Track or any other trading tracking platform, but I'm gonna make it really easy for you. Go back to trades that you've made that you've closed like a month ago. Do that like so it's about the end of May here. So go back to trades that not that you started, but trades that you actually closed down 30 days ago that you closed down in April, and then look at that chart and then mark on the chart where you actually bought the stock if we're just talking about longs, and most people are long only. So put a little green dot, I don't know, do whatever you want to do, but put some indication on that chart of exactly where you bought the stock. Okay, you don't have to do anything more than that. Put that one little mark on there. You can even use a little marker, a pen, whatever you want to use. Put that one little dot there and then just analyze the chart, because what you've done is you've said, this is where I've entered and this is what happened after the fact. And also, this is what happened before the fact. So, what you're doing is you're pinpointing that one moment in time when you decided to take your money out and put it on the table. And then you look at that and say, okay, let's go back further, Dan. Why did I decide to do that? What was my rationale for buying that stock right there? Okay, that's one part of the trade because you couldn't see the future. All you could look at is the price history of the trade of the stock. And then for whatever reason, you made the decision right then, right there to buy the stock. Why did you do that? You should be able to point at the chart. This is where you ultimately want to be. You should be able to point at the chart, look at the prior trading history, whether it's for a week if you're doing super short-term trading, or typically like if you're kind of swing trading or whatever, or trend trading. Look back and see what the stock had done the previous 2 months, 3 months, 4 months. Look at a weekly chart, but really analyze the price action in that chart before you actually made the trade. And here's a little pro tip too. You can go even a step further and move the chart back so that you don't see the future. You can move the chart back on your screen so the hard right edge, the very right edge of your chart, is exactly what you saw when you bought the stock. Now you have a repeat episode. Now you know, okay, this is exactly what the chart looked like when I bought the stock. What was my process? And you look and see what you like. Did you follow a process? Did you even have a process? That's all you literally need to do. Forget about where you even sold. I mean, yes, you should, but let's just talk about the entry. Just do that, then slide the chart back to present day and see what happened. Was that a good trade? Okay, I've gone into a lot of detail on that. I will go into even more detail at another time, but that ain't this. But what you need to be doing is not trading what you think, not, well, I felt really good about that one, but it didn't work out. No, the market doesn't care if you felt good or bad. The market cares, your money cares if you followed a process. And the only way you can really know if you're doing that consistently is to go back and look and see what did I do? Okay? So, what I want to do after all, about a half hour or whatever it is, I just want to look at this focus on bases and breakouts. Okay. And I'm going to make this really, really easy for you. But this is really what I'm focused on. And I had a real basic course last weekend. If you haven't seen it, maybe you want to go back and watch it on on bases, on entries, really, not bases, but entries. And the email, the copy of the video or whatever was entitled, The Entry is Everything. But if you look through this and you say, like, your strategy determines your type of entry, market conditions affect the success of the breakout. Again, these are entries, bases, and false breakouts. Actionable. Has your trigger been done? What's your risk reward? Are you tracking your breakout entries and have they worked or not? Have they been working? And you will, by the way, find you're making the same mistake again and again. And the point is, your entry, if you just focus on the right entry, it's kind of like almost the stock doesn't matter. And the reason I say that is because if you know what your entry has to be, then most of the stocks that you look at, they don't even get past the first glance. So you have to be really focused on where is my entry on this. Okay, now here's the other thing. The stock isn't always the problem. Sometimes it's the entry. So the late entries, go back to think about what I was just saying as far as risk reward. If you're chasing a stock, it's already kind of given up a lot of its potential reward and it's at more of a risk of pulling back. So if you're late, that's a problem. If you're early, that's a problem too, because it may not ever set up. You may be wasting a lot of time, or stock may move against you. And then you look at it later and go, why the heck did I even buy that thing? And so you don't want to be having bad entries by chasing. And also, this is something that may resonate with you. If you have a bad entry, you're buying high, you're going to sit there and you're going to look at that stock. And let's say it doesn't come back down. It's, you're good, it's fine. But you bought high. And then the more you look at that position, the more it kind of bugs you because you realize, okay, I bought high on this thing. And now I'm not willing to accept much of a pullback, even if it's a natural pullback. Why? Because I'm playing with my money. I'm not playing with the house's money. You see, if you buy a stock right, then it will run up. And now you've got a profit. And once you have a profit on a trade, then you have a better chance of being able to sustain a normal pullback because stocks do go up and down. They don't just go up, if only. Only thing that goes up constantly is our national debt. But the point is, if you've got a profit in the stock, then you're looking at a natural pullback and you're saying, okay, well, that's a good thing because hopefully this is like regrouping and then I can get the next move higher again. Maybe I should buy more. And then that's a whole different analysis. But all of that comes from a good entry. If you've got a bad entry, hello, shakeout. Can happen a lot. Okay. And then so let's look at like what a base is here. And a base is a consolidation area. It's a resting period after a move, and this can be different. A base can be a big old long base breakout, or it can already have had a big move, and now it's just resting. I kind of described that. Okay. And on that situation that I mentioned when I was talking about these power moves, institutions can be accumulating shares during the base and it can be a high base, like you had a big power move and then the stock just drifts sideways. Well, that is a base. It's a high base, but it is a base. And so the whole thing is we're transferring stock from weak hands to strong hands. And there's no, I'm a weak hand. I'm not going to sit there and look at a stock that's going down to zero and going, oh, I'm in for the long haul. No, if a stock's moving against me, I got to be out because it's not about me ultimately being proven right on the stock. It's actually me keeping my money. Okay. So, and think about it this way. Bases are, you don't just want to be buying a base. I mean, all you're doing then is sitting there while institutions are accumulating the shares all around you. And that's not a fun place to be. So bases are often just where the next major move is being prepared. That's the best way to look at it. So the breakout trigger. You want to insert a breakout chart here. You go ahead and look at this stuff and just see where do I need to see, like where can I see what the resistance level is? I'm looking for volume confirmation. I'm looking for the trigger point. And then think like, why are traders entering here? Think about that. Why are traders entering right here? And also, as you're doing that, think, where is the trade that it becomes actionable? Like, when do I get into a trade on a breakout so that I know that I'm in at the right time? And this is where timing, comes in to play. We'll look at a chart in a second. Next slide. So you got to be thinking about along these lines too. When you get false breakouts, institutions are hugely responsible for moves in stocks, more than you probably realize. Like I talk about, oh, Billy Bob and Jethro buying stocks and stuff like that. It's Goldman Sachs and Morgan Stanley, and big hedge funds. They're the ones that are providing and they're creating liquidity. And the way institutions create liquidity is they push the stock. They'll push the stock higher above a breakout to see if additional buyers come in. And if they do, maybe that institution wanted to sell some shares. And so the way they sell shares is they juice the stock up to a level where they know it's going to attract momentum traders. And then they start selling into that. Okay, guys, well, guess what that is? It's a fake breakout. It's a false breakout. It's a bull trap where you see the stock going up and you buy it, and then institutions say, thank you very much for buying my stock. And then it's the same thing on the other side of the coin, where if institutions want to buy stock, they will often push the stock down just to find your stop. You can call it stop hunting. I just call it liquidity creation. They're looking for pockets of liquidity where they'll push a stock down below support because they want to buy it. And that gets sellers coming in. And then the institutions say, thank you very much. And they buy that stock and it ultimately goes higher. And they can do that. Think about it this way. They can do that during high bases. This is important. I'm giving you pearls here. They can do this during high bases where you're looking at a stock and you're going, my God, this thing's going to have to turn around and fall. It's going to have to. And you're holding the stock and you're waiting. But the stock's still up in an elevated range, right? It's way up above the 50. It's not pulling back, but you just know it's not going to go up much farther, if at all. So you've got a real itchy trigger finger to sell. The stock comes down. You sell your stock. Maybe you made a profit, maybe you didn't, but you sell your stock because it's like, oh, this is the reversal that I've known was going to happen. And then the stock runs up even higher. Okay, well, what was going on there? Well, first of all, the reason the stock wasn't originally coming down was that institutions aren't selling. They want to buy some more stock. They just don't want to be bidding against themselves. And then second of all, so they want to buy stock. And then at some point they say, all right, we need to shake the trees here a little bit. So they knock the stock down, shake out all the weak hands. They buy that stock and then the stock goes up even higher. Guys, that's why they call it trading, not winning. Okay, so the thing is, like I said here, it moves where it needs to move in order to create liquidity. And it's not personal to you or me. It's just what the market does. So if it's revenge trading ever, it's revenge against yourself. It's not revenge against the market. The market didn't win. The market didn't lose. The market didn't take your money. The market didn't give you money. The market just did what the market does. It's all you. That's why, like, if people, a lot of times I'll see people in the trading room or I'll get an email or something and thanking me like, hey, my account's up 80% this year, or thanks for this trade or that trade, whatever it was. And I always say the same thing. I appreciate you letting me be a part of it, but it's your trade. It's your money. It's your decision. It's your accolades. Let me pat you on the back. And that's the way you want to be thinking about your trading as well. You want to always be mindful that it's your decisions that you're making within a market that doesn't know about you. It's kind of like surfing. I've talked about that recently. It's just about surfing. You want to be timing the waves just right. And if you don't, it's not because the ocean doesn't like you. Okay, so that's that. Now, let's look at this. This is what I'm talking about here. I just I can find a bunch of charts and I'll actually show you SanDisk in a minute, but they can be kind of noisy. So I thought I'll make it really simple for you. So this is an uptrending stock. The base really kind of starts being formed after a little sideways move here. And if I wanted to, I could have drawn the green line, the support or line like up to 52 or whatever, but I just left it down here to account for shakeouts. So this is the base. All right. Notice the volume down here. So this is resistance, pulls back, stock comes back up to the high here. This was a pivot right here now. This was a pivot because the stock came up and pulled back. So that's the pivot, breaks out here above this prior resistance. And it's kind of minor resistance because it was only one top in an uptrending stock. So who the heck knows what's going to happen? Okay, so the stock comes back up here. It doesn't pull back. It breaks out. And you say, here's my chance. Now I'm in on this breakout. What happens? The stock comes up and then pulls back down. So what was this? This was a lack of institutional buying on this once it broke out. And maybe it was trading at, I know, low volume. So this was a low volume breakout and it wasn't ready to move higher. There was still more work to be done down here. So the stock comes back down and you take your loss, either a big one or a little one. But you take the loss. The stock is still right in the base, comes down, and now it's forming support right here. It's showing support right here again, and then here's another false breakout. A little bit better though. Volume was a little bit higher here, a little bit higher. But then it comes back down again, low volume. And then finally, we get a move here. Volume has started to pick up already. We get a move here, but once the stock ultimately breaks out, and you could say, well, now resistance is clear up here at these false breakouts, fine, whatever floats your boat. All I'm saying is the stock starts moving higher. It breaks through this level of resistance. It's pushing up here. And what's happening with the volume? We're showing in a big volume here. And so what does this mean? It means institutions finally are done accumulating the stock. Now they're just buying it. And retail traders come in like you and me, and we see this stock as well. So this is just the way stocks trade. Okay. And you have to, you want to be understanding that just so you have a basic idea of how bases work, and you can get shaken out a few times. But the most important thing is what's happening with volume. Okay. So you always, again, just want to consider risk versus rewards on breakouts. You got to be doing that. And when is it going to be considered a failed breakout? You look through this, and if you're not asking how much you can lose, first ask whether the opportunity is even worth pursuing. I've already talked about that. Okay, so just a couple more here, and then I want to get to just a brief look at the market. So entries matter so much because, again, they create an emotional cushion. If you're profitable, you have a little more mental and financial flexibility. You avoid the fear, and you don't have so much stress. But the market pays you for being right early. The market doesn't pay you for guessing. Sometimes you get paid, but that's just luck. It's not the market. So my takeaways for you are this. You want to wait for the actionable setups. You need to define your risk clearly. I want you to be thinking about aligning your entries with strategy. If you're not doing that, then any entry will do. Okay. You need to be looking at the market. You need to always be looking at potential reward first, because if there's not enough reward there to make it worth your while, then any risk is too much. And then again, you want to be tracking your performance. So, and this is definitely true. Most traders don't lose because they picked bad stocks. They lose because they entered good stocks badly. Okay. So, and that's a total truism. So, all right, catalysts for the week. These are stocks that are likely to move pretty big, I think, and we'll look at this here. By the way, this is an example. This is an example of a proper breakout right here. Look what's happened to the volume. I just saw this. I was looking at this beforehand, so I'll show you real quick. Okay. Stock's been trading on pretty low volume here, still within the within the trading range. And then finally we get this big move higher on massive volume. All right, so the stock's at 348. Too late to enter this stock, right? Well, not so much. This was a massive institutional buying breakout. If you were really looking at this, seen you could have even picked it up here. You look here, the volume was ticking higher. So this is really just what we want to look for. You have to be comparing the price action with volume, and you think about it this way. Volume is, I think I heard Kramer say this, but I think he ripped it off from Barry Ritholtz, that price volume is truth. We'll put it that way. Price action is the story, and volume tells you whether it was a tall tale or whether it's true. Okay, so that's just another example of a breakout. Now, I'll just go to these four stocks here. So, AutoZone reports. That'll be pretty volatile, but this is nothing that I want to buy unless it's for a day trade. Marvell. They're going to have to report some pretty strong numbers in order to move higher. Okay. And I'll be looking at these more on Tuesday. CRM, no thank you. Software. This is like, this stock is in the sweet spot for getting mugged. It's CRM, people don't pay for seats anymore. Hell, they watch TV on Netflix. They don't go to the movies, so they don't pay for seats. Now, how about Snow? Snow is another one. I'm not going to guess which way this goes, but I just know it's going to go a lot. And then this last one, PDD Holdings, is also trending down. So I'm looking at these stocks as potential trades, but the only strategy that they fit is they're setting up for good opening rotation trades. None of these I would put on the active trade list, not with anybody's money. So basically, right now, the market sentiment is still bullish on AI, earnings beats, but then rate outlook, by the way inflation's looking and the oil and all that stuff, hell, we could be getting a we could be getting a rate hike. I mean, conditions change, the Fed changes, and just because 6 months ago, 6 weeks ago, last year, whatever it was, everybody was clamoring for a rate cuts, that doesn't mean that the Fed's just ultimately going to cut. They're looking at data, and if they start raising rates, that can be a real drag on the market. I don't know whether they are or not. I have no opinion on the matter. I'm just telling you that's what could happen. Then we'll be looking at jobless claims. But then also, and I'll kind of end with this, we've got a shortened week, Tuesday through Friday, so you're going to have lower volume here. People are kind of getting ready for vacations. Now, I want to go over something real quick. So I've been holding these 59-minute trading sessions for people that have taken the 59-minute trader course. I'm expanding that, frankly, due to popular demand. That's why. It's kind of been, I'll just be candid with you. It's been this accidental thing that Karen started getting a lot of requests for 59-minute trader tactics, maybe another workshop, which could be in the works, and then just live trading sessions. And so I was talking with Brent Capello. He's my Swiss Army knife for a lot of things, trading as well as marketing and web maintenance and stuff like that. But I was talking to him, and he said, why don't we just put one together, send it out to 59-minute traders, and just see what happens? So we've done that. I think about six, maybe seven of them, and every single one has been smoking hot. And so I'm just pointing that out to you. If you've taken that class or if you're going to take it, these people are really making money. And I've just posted some of the comments here about Ken. Okay, he made an 11% gain. All right, well, that's fine in 15 minutes. Not a bad deal. And this was a call option, one call option. We had one guy, and I apologize, I forget his name. This was on this stock. Yeah, he put half of his account. He felt so confident in what he was doing. He piled into this and made, I think he said like 200,000 bucks or whatever on this. And so I'd have to say that was a success. Now, let's look at the other side of the coin, though. On Friday, it was a lower volatility market because NVIDIA didn't really do much and everybody was looking at NVIDIA. We were too. But then it didn't take but 2 or 3, maybe 5 minutes to say, all right, this thing isn't going to move at all, so we need to move on. So we did, looking around, rummaging around, trying to find some stocks that we could kind of hang on to and say, okay, this is the one, or these are the 2 or 3 that we're focusing on. But you stick with it long enough and you're going to find stuff that works. And then ultimately, that's what we did. And so we've had people, and there was one guy, this was Sean. So Sean and Ken have made a ton of money. Now, there was one there was one gentleman who was in there and he was really struggling. I think ultimately he made money, but he was really struggling. And I think, and that happens. Like I said, if you haven't been doing it long enough, if you haven't been doing it for very long, you kind of don't deserve to make a lot of money. But he was struggling with looking around, with us saying, oh, well, maybe this will work. No, maybe this will work. And so that's the downside to this. That's the downside to where you don't just get to come in, and this is just trading in general. It has nothing to do with me or these trading sessions. This is just trading where you can be looking and you say, I want something to do. Like that line in from The Office. If I don't get if I don't get a piece of cake pretty soon, I'm going to die. The idea is you're looking for trades, and the only ones you can find are ones that you don't want to take. That can be a real problem. But in this case, he's patient. We're patient. We're looking. There's one. Okay, it's going. So we buy it right at the low? No, we just bought it at the low where we bought it from, and then the thing ran higher and it rewarded us. And so we were trading Qualcomm and a few others as well. So I'm just pointing this stuff out to you. It's your decision whether you want to learn this type of trading or not. Again, I'm just making it available if you want to do that. So anyway, so these are, again, just some of the things that people have said. They're intended. I mean, I say it every time. My intent is for you ultimately, like right out of the get-go, to pay for the price of admission. So at least you're playing with the house's money now. So anyway, hope you will join us on one of those things. And if you don't, that's okay too. All right. So thanks for sticking around here. This has been a little bit longer than I had anticipated, but that's kind of the nature of these weekend sessions. I want to be conveying more, I guess, kind of more trading knowledge, more trading experience, as opposed to saying, okay, Western Digital's on a pullback here, so buy a little bit more and keep a tight stop. I mean, we do that every day. And I will be sending out like kind of shorter videos during the week rather than only having you wait for like an end of day strategy session. Just a little quick hit to give you something that I think is interesting or important to give you. So, okay, that's all I got for you. You guys have a great weekend.